Look, we've seen you make a lot of money over the past, really since that period, since the bankruptcy period, 2008, 2009, even into 2010. And they can't hide that. The manufacturers can't hide that. I think what they're going to try and get out of these negotiations, the manufacturers that is that flexibility to adjust capacity and headcount going forward, because even though they've made more money, the production, especially in North America and US specifically, is down significantly. So the idea that the manufacturers kind of pay up for their earnings through these contract negotiations also has to include the idea that, hey, if we move to a smaller market, which is what has happened, and especially if electrification means fewer unit sales, as that volume declines, you have to have that flexibility to take out headcount or production capacity going forward.
So there is a pretty big bid-ask spread here. I mean, I guess the auto companies are talking about a 21% increase, and I think the last proposal from the unions were something like 36%. If you had to guess, I mean, do we just do a simple split the difference, or is there a level upon which when these big folks in Detroit look at Elon Musk and say, I can't compete at 36% increase?
Yeah, that is going to be difficult. But again, if that flexibility there is to adjust to a market that is, 15 million units a year going forward, but at $52,000 in an average transaction price, the revenue pool is actually larger, even though the unit volume is down. So I think what you're going to see is the ability to pay up. So if I had a bet, I would say that the likelihood is that the union gets closer to their number than what the manufacturer is willing to give. But again, that flexibility on the other side to say, yeah, if this is a 15 to 16 million unit market going forward, where we're used to 17 plus, then we have to have the ability to close plants, take out some headcount, and adjust to the market going forward.
I mean, maybe they'll be able to give a huge raise in wages as cover for getting that kind of flexibility from the UAW. Because, you hear numbers like 20% and you think that's probably going to break these automakers. But it's not, because people don't realize how small a percentage of the cost labor actually is, right?
Right, and again, that 20% or 40% or whatever it ends up being is over the 4 years of the contract, so it's not immediately all at once. The other one is going to be the signing bonus for ratifying the deal, which would be a nice number. But really, that's what the manufacturers have to give, is to give back some of that profitability they've earned over really the past decade, or since the bankruptcy period. That's what they're going to be able to do. But ultimately, the idea of having too many workers or pensions and legacy costs going forward, that's where the manufacturers, that's where it would hurt them, not so much in the hourly increase in the wage going forward, because you can cut costs, right? You can increase revenue, which is what's happening as mix shifts to truck from car or to electric from internal combustion. But you have to have the ability to right-size your business going forward.
So do you think, I guess just the question, I think I would guess if I were an investor considering, any one of these auto companies, is just, do I think these companies can generate better, worse, or the same returns in an electrified world versus internal combustion world? Do you have a view on that?
Yeah, I mean, so far it looks like worse.
Yep.
And I think what we're starting to see is a little bit of pushback on that. And I've been saying this for years, is that the U.S. is behind in EV adoption, not because the consumer does or doesn't want it, or it's expensive, or it's just not as profitable as the business that the manufacturers have been doing forever, which is an internal combustion.